Moving on, Torrent Pharma has acquired Curatio Healthcare for 2,000 crores, but the stock is under pressure today. Ekta has been telling us how it seems to be quite an expensive acquisition for them. Ekta, over to you.
Well, Sonia, it's also an interesting acquisition because I've really been working the phones the entire morning to understand what the street likes and dislikes about this particular acquisition. So, for example, the total acquisition size is around 2,000 odd crores. They are buying 100% in the company. But this particular company has a strong presence in the cosmetic dermatology market. Now, this cosmetic dermatology market focused on pediatrics. I'm sure a lot of us, Sonia, I'm sure you must have used a couple of these brands, or at least heard about them within the pediatric space. So, for example, Teddy Bar, which is around a 76 crore brand, it's 34% of sales for this particular company. At Gola, which is basically for atopic dermatitis for kids. Spoo, which is a sulfate-free shampoo. Before Nappy, which is a popular nappy cream. So, top 10 of these brands are around 75% of the company's sales. So, they have a strong concentration in terms of sales, but they are growing. So, they are expected to cross 275 crores in terms of total sales in FY23. This compares to around 224 crores that they did in FY22. Now, margins, yes, they are a bit dilutive. So, these are the deal concerns, which I'm just going to list out. The deal itself is valued at around 7 times sales to price on an FY24 basis. So the street finds this deal expensive. Margins of the acquired business are slightly lower. So, for example, they would work out to be around 25% odd. Torrent has higher margins. So the street is anticipating that hopefully synergies will allow the company to increase their margins. 75 to 85% of the company's deal will be funded via debt, though they've said that by FY25, they should probably reduce the debt. 60% of their sales will now come in from the domestic business, which has been doing well. For example, it was up 14% in FY23. Brokerages seem to be positive. They really haven't changed their stance, which is indicative of how negative you could be. So Citi is neutral. They say it's a good strategic fit, but it is expensive. And that's the similar kind of, statement which is brought out by the likes of Credit Suisse and the others as well. That yes, expensive, but there are some positives in terms of, entering the dermatology segment, etc. The management did hold a call last evening. So let's listen in to what they had to say.
We expect that this year the growth should sustain and possibly touch about 275 crores. And the gross margins of the business are quite identical to the base business that we have currently, the Torrent India business. And while the margins of the acquired business are slightly lower, I think there is a possibility to bring these margins up to the existing India-based business level in the near term. So there are possibilities for synergies both on the cost and revenue side that we see visible, and hopefully should start playing out within the next couple of quarters. And we will keep everyone informed on the progress as we move along. It's more appropriate to look at the multiples on the current year basis rather than the trailing year basis, particularly because this is a asset which is still in a build-out phase, and we see reasonable growth potential that's yet to be seen in terms of top line. And given that the top line base is still relatively smaller compared to our existing base, the operating leverage should start playing out in terms of margins. I think both factors here, the top line growth, which would be higher than the industry growth, plus possibly our base business growth, and the additional levers for margin expansion as we go along. That's why we felt this is a justified opportunity.
I think FY22 numbers which were there in the public domain was that top line of 224 with EBITDA of little over 60 crores. So that's the kind of margin which it has made in FY22. And with the growth being significantly higher than FY22 this year, as we spoke that YTD basis, the business has been growing at 25%, and we should expect this momentum to continue for the full year. The operating leverage is playing out much better way. The margins should be reaching the margins which we have for our base India business. From an overall company perspective, it's a little higher than the overall company EBITDA margin. So from that perspective, it's not going to be dilutive from a company perspective. In terms of cost synergies, what we are looking at is from a procurement perspective. So basically the COGS, there should be some improvement which will start flowing in because I think between Curatio and Torrent has a better reach and negotiating power. The other one is, of course, the productivity improvement, which is going to span out over the next few years. And the third is certain fixed expenses where our cost structure is more efficient compared to Curatio. So once these businesses merge and come to the same platform, there would be cost synergies flowing in. On an immediate basis, at least for the next 1 or 2 years, we are not looking at any incremental investments.